Hi everyone, and thank you for tuning in. In this video, I'm going to highlight 3 stocks that are down 51 to 83% that risk-seeking investors can buy now. So let's get right into it. The 3 stocks that I'm going to recommend today are Pinterest, Shopify, and Airbnb. Airbnb is down 51% off its high. Pinterest is down 73.36% off its high, and Shopify is down a whopping 83% off its high. So why are these stocks a buy today, and what's the risk that they're facing? Let's look at those individually below. So Airbnb is a worldwide travel facilitator that was devastated at the pandemic's onset but is recovering nicely right now. And Airbnb adds customer value through a broader selection. You can imagine if you're going on a trip, you might be going on a trip by yourself, in which you would want fewer accommodations. You might only want a single room, maybe a room in an apartment for a few days. Um, Maybe you're just going, maybe you want a longer trip, maybe you want a room in an apartment for 3 weeks perhaps. That's difficult to find at a hotel, or it might be expensive to get, to book a room at a hotel for 3 weeks. On Airbnb you could potentially get a lower rate. Similarly, you might be going on a trip with your family for 2 weeks, and you might not want a hotel. Instead, you might want to rent an entire home. On Airbnb, you can find both. So depending on what kind of trip you're going to take and how long and with who, you can book the kind of room that you're looking for. That's the advantage it has over traditional hotels that kind of have this one size fits all. Here's your hotel room. Doesn't matter where you're at. It's kind of a cookie cutter room all across the country, all across the world, and that doesn't it's not as much of a custom fit as customers would like, and so that's why Airbnb is gaining traction. Secondly, I noted that Airbnb was devastated at the pandemic's onset because worldwide travel came to a halt. Travel spending went from $1.5 trillion in 2019 all the way down to 610 billion in 2020. A massive decrease, a massive fall off. Now that recovered a little bit to 950 billion in 2021, but it's still over 500 billion below where it was before the pandemic. It's going to recover some in 2022 and 2023. It's not going to get all of it back in 1 year. So investors in Airbnb can benefit from that rising recovery in travel spending. So why is it risky? Well, a risk of recession is elevating now with inflation worldwide approaching double digits and central banks around the world raising interest rates to combat inflation. That could cause a recession, and when there is a recession, people usually spend less money on travel because it's more of a discretionary category. The second major risk here is that it has little control over the customer experience. I noted earlier that it has a broad selection, and that broad selection can be an advantage, and it can work against Airbnb. Airbnb does not own any of the properties listed on its platform. It has hosts. It encourages hosts to list a room in their apartment, to list that second home for rent. And so it relies on these hosts to provide a good customer experience to those travelers. If there are bad hosts, then the travelers will have a poor experience and they will unlikely come back to Airbnb. Airbnb has little control over how hosts treat the customers. Sure, they can observe the reviews, and if a certain host gets bad reviews, they can, ding them and delist them from the platform and all of that. But it's still not as strong of a quality control that traditional hotels have, because they control the process from beginning to end. So that's why Airbnb is risky. Okay, moving on to the second stock I recommended is Pinterest. So Pinterest is a image-based social media company with free user-created content. So not only is it free to join and use, but also, which if it's free to join and use, it's easier to attract customers, but also those same users create content for Pinterest, and Pinterest doesn't really have to pay them. That's free user generated content. That's an excellent business to be in. So if it's free to join and use, how does Pinterest make money? Well, it shows advertising to people browsing the platform, and advertising is a massive market opportunity. The advertising industry generated $763 billion in 2021, and that was excluding political ads. So it's a massive industry. Marketers are always willing to pay money for the potential to influence your purchasing decisions. They want to get you to spend money at their business, to spend money on their services. So they're always willing to advertise, pay for advertising. So why is Pinterest risky? Well, TikTok is growing robustly, rapidly, and this is coming at the expense of other social media companies. Increasingly, the younger generation is spending more time on TikTok, and that's taking away times that when they open their phone, instead of opening the Pinterest app, they open the TikTok app, and they oftentimes will never get to opening the Pinterest app. So that's a risk for Pinterest, especially if this popularity continues to grow for TikTok and Pinterest cannot find a countermeasure to get user attention back. Secondly, Apple has made privacy policy changes to its platform late I want to say later in 2021. That's making it harder for Pinterest to sell targeted advertising. Pinterest used to be able to collect its user data and track what you do across the different apps on Apple iPhones and iPads and other Apple electronics. It is more difficult to do that, and so now it cannot sell those targeted advertising. And so if Pinterest cannot sell targeted ads, then marketers are not willing to pay as much because there's going to be more waste in those advertisements. And so that's creating a little bit of elevated risk for Pinterest investors. Okay, the final stock I mentioned was Shopify. Shopify enables merchants to develop an e-commerce platform, and they're going to benefit from the tailwind of more and more folks spending money online. That trend has been increasing over the years. It accelerated during the pandemic. It's pulling back a little bit right now as folks are unleashing some pent-up demand for away from home items, away from home shopping. But over the longer run, people are going to spend more money online. It's just a lot more convenient. It saves you on travel expenses. It saves you time. And so that trend is just going to continue increasing. It's not going to reach the point where it's going to be 100% of shopping is done online. I'm not saying it's going to get there, but an increasing percentage of shopping will be done online over the years. And Shopify has demonstrated an excellent customer value proposition because it keeps bringing merchants back to its platform. Revenue has exploded for Shopify from 50 million to 4.6 billion from 2013 to 2021. So almost a 10 times increase in its revenue over those 8 to 9 years there. So why is Shopify risky? Well, they used to be exclusively an asset-light business model. They weren't getting involved in logistics. More recently, they've now decided to invest billions of dollars in their fulfillment services, and that could prove costly and wasteful. We don't know yet. Investors don't know how these investments will pan out and whether merchants and entrepreneurs on the platform are going to find those investments worthwhile and be willing to pay an increased rate for the privilege of having those services, offering those services to their customers. Secondly, the other risk for Shopify is what I mentioned a little bit earlier, in that consumers, after being cooped up at home for the better part of 2 years, are now wanting to get out of the house. They're wanting to spend money on away from home experiences. They're going to restaurants, they're traveling, they're going to concerts, theme parks, ball games, and they're spending less money shopping online. And so that's a headwind for Shopify in the next, depending on how long this trend lasts, 2 quarters, 4 quarters, 6 quarters. It's uncertain how long consumers are just going to want to get out of the house and not find any excuse to get out of the house and not spend money inside. Okay, so there you have it. 3 stocks down big that risk-seeking investors can buy now. Okay, let me know what you think of the stocks below, and if you liked what you saw, I post videos like this daily, so feel free to subscribe below. Thank you for watching, and I'll see you next time.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.